stop scrolling for a second, because this jobs report just shocked economists. The US economy was supposed to add jobs in February. Instead, the economy lost 92,000 jobs. And if you're thinking about buying or selling a home this year, this report might affect you more than you realize. Because when the job market shifts, the housing market usually follows. So today we're breaking down the February 2026 jobs report, released March 6th by the U.S. Bureau of Labor Statistics, delivered one of the most surprising labor market reports in months. Economists were expecting the economy to add between 50,000 and 60,000 jobs. Instead, the labor market contracted sharply. That's a huge miss, and it's raising new questions about whether the economy is finally starting to slow down. Let's break down the key numbers. First, non-farm payrolls. The U.S. economy lost 92,000 jobs in February. That's the largest downside surprise in months. Second, the unemployment rate ticked up slightly to 4.4%. It was 4.3% in January. Now that's still historically low, but the direction matters. Third, the labor force participation rate fell to 62.0%. That's the lowest level since 2021, which means fewer Americans are working, or even looking for work. But here's where things get interesting. Wages actually increased. Average hourly earnings rose 0.4% for the month, 3.8% year over year, both higher than economists expected. Now the big question, what caused the job losses? One major factor was labor strikes. A large strike involving Kaiser Permanente workers sidelined more than 30,000 employees during the survey week. Because of that strike alone, the healthcare sector lost 28,000 jobs. Another factor was severe winter weather. Major storms across parts of the country slowed down hiring in sectors like construction, leisure, and hospitality. But here's the part economists are watching closely. Even when you remove those temporary factors, hiring was weak across most industries. Manufacturing payrolls, for example, fell to their lowest level in 4 years. And there's another detail in this report that's raising eyebrows. The government revised previous job numbers downward. December was revised from a 48,000 gain to a 17,000 loss. January was also revised down slightly. Altogether, those revisions erased 69,000 jobs. That means the labor market may have been weaker than we thought for months. And February now marks the third job contraction in the past 5 months. That's a trend economists can't ignore. Financial markets reacted quickly. Stocks dropped after the report was released. Meanwhile, the 10-year Treasury yield stayed volatile around 4.15%. Why does that matter? Because the 10-year Treasury strongly influences mortgage rates. And the big story now is the Federal Reserve. This weak report makes the Fed's upcoming March meeting more complicated. Some traders now believe the Fed may need to cut interest rates sooner than expected. And if that happens, mortgage rates could finally start trending lower. So what does this mean for real estate? Jobs are one of the biggest drivers of housing demand. When the labor market is strong, people feel confident buying homes, but when job growth slows, buyers often become more cautious. However, there's a twist. If weaker job growth leads to lower mortgage rates, that could actually boost housing demand again. Lower rates mean lower monthly payments, more affordability, more buyers entering the market. So the housing market could be caught between two powerful forces: slower economic growth, but potentially lower borrowing costs. And the direction rates move from here could shape the entire 2026 housing market. The February jobs report may be an early signal that the economy is losing momentum, but for the housing market, the bigger story could be interest rates. If weaker job growth pushes the Federal Reserve toward rate cuts later this year, that could reshape the real estate market in a major way. So the next few months of economic data will be critical, because the question now is simple: was February just a temporary shock, or the beginning of a larger slowdown?
Your ultimate hub for real estate insights, breaking news, entrepreneurial wisdom, investing strategies, and self-development hacks. If you're ready to expand your mind and stay ahead of the game floor, you're in the right place. Subscribe now. Your future self will thank you.